talk us through a little bit, kind of your two companies, your book. Give everyone the high level just to set the stage, so we can kind of then start diving into you as an entrepreneur, and then what are the qualities that you've seen from the really successful ones who've made it and who haven't.
I would say, that's really largely comes down to the commitment of the entrepreneur. There are certain reasons why you might want to go public. Obviously, one of those is access to capital. So if you have private funding sources and you're happy with the structure and the access to capital there to grow your business, and you want to stay private, then it's a natural. Work within the VC community, work within the PE community, work within those funding circles and sources that you have access to.
What are the biggest downsides of taking a company public? So, I mean, you mentioned one, at least in my opinion, which would be the short-termism of the market. Like, I'm my own company. I'm very focused on the long term. I think us making investments today will have massive payoff for us in the future.
Yeah, unfortunately, a lot of those dynamics are outside of the control of management. And in today's market, also, you have all this downward pressure that's coming from, market sellers, even shorters, both, legitimate and naked shorting. So if you put that part aside, but it's a significant factor. I don't want to step over that, because those are out of the control of management, right? They don't have the ability to impact and implement their business plan, while combating all those other components that are out of their control.
Welcome to the next episode of the Entrepreneurial Excellence Podcast. It's great to have Peter Goldstein here with me. He is the founder and CEO of both Emmis Capital and the Exchange Listing LLC. Both of these companies really focus on helping startups and entrepreneurs make a move towards going public, which is something that, of course, fewer and fewer, I should say, companies are doing nowadays, because it's become all the rage to stay private for as long as possible. So for me, it's great to have Peter here and understand, hey, there's all these alternatives to capital that's out there. Public markets are this really big one that's sitting there, and maybe help us demystify what that looks like. What are the right sort of founders and companies to potentially go public? Why they should, which ones fail at that or just fail at fundraising, and talking through all those different pieces. So Peter, welcome to the podcast.
Thanks,
today.
Adam. It's great to be here. Great to be with the audience, and as a serial entrepreneur myself, I feel like these topics are really at the heart of who I am, and I know who you are and who your audience is. So look forward to a great discussion.
Absolutely. And I should actually add, I forgot to add that you're also the author of the Entrepreneur's IPO, a book that came out back in December of just last year. So very recently, talking on this topic of who should go public, what does that look like, sort of the playbook, right, for that. So talk us through a little bit, kind of your two companies, your book. Give everyone the high level just to set the stage, so we can kind of then start diving into you as an entrepreneur, and then what are the qualities that you've seen from the really successful ones who've made it and who haven't.
Great. Yeah. So I think, in my career as an entrepreneur, I'm 60 now. I started in my 20s. This iteration, Exchange Listing, is roughly 4 years old, and we are an IPO advisory firm. And we're really created to service entrepreneurs who fit into the small cap or micro cap segment of companies that are pursuing an IPO, or have already gone public and maybe public on a lower exchange or in another country, and would like to upgrade to a senior exchange such as NASDAQ or New York Stock Exchange.
Just help everyone define what is the micro cap. Sort of what does that mean in your definition? Like, is that a revenue number to make a micro cap? Is it a valuation number? What is that defined as?
In this case, it's typically defined as a market capitalization. So overall total market cap. Yep. And 50 million to 300 million is the typical range for a micro cap. Anything below that would be a nano cap, so below a $50 million market cap.
Who's setting those valuations? Is that, I mean, that's the market when you go public, but before you go public, who's setting that valuation to even say, hey, like, you're ready for an IPO? That's
typically done in conjunction with, and the mark to market would be your last round of financing, right? So there is your kind of, bar, and then the rest is really in negotiation with the investment banker, the company, investors, and we play a role in that. It's not a traditional, kind of discounted cash flow or other model that would be used in tech to look at, kind of future value. It really, because the markets, as we look at it, people are buying in at a set price, their ownership at the time of the IPO. So that's still done in a sense as a market approach where, there is an auction, right? And so no matter how many times I've been through this, including taking my own companies public, the one variable that exists when you're doing an IPO is going to be what's the sentiment around the valuation by investors. And that's why some IPOs are done in a range. You have a higher range and a lower range, but typically that range is already well organized in dialogue between yourself, the company's CEO, the investment banker, and some of the current and future investors.
How much effort, kind of, there's so many questions I want to ask, but let's talk about sentiment for a second. How much does the banker, the founders and CEOs, what role do they play in creating that sentiment? Because at least my impression of sentiment in general, it's kind of a game, and it's who can tell the best story and then maybe ride a wave that's happening. So if you're an AI company trying to go public today, that's probably really hot just because everyone thinks AI is really sexy right now. But what role and how impactful can the founder, the CEO, the entrepreneur be in creating that sentiment, which theoretically then increases the valuation that you can get when you
there's two sides. I think there's that role which the founder, the CEO, and management has in telling and positioning a story in the company. And then of course there's the reality of the market. Like if you're in a hot market segment, and then you're also looking at comparable companies. So you have to have some way of being able to have a mark to market or a comp to be able to compare yourself as a significant, I would say, realistic comparable value. In other words, if you're an early stage startup, you can't, in the AI space, you can't compare yourself to NVIDIA, right? You just have to be very realistic.
But are you comparing yourself though to, let's say you wanted to go public as an AI company, do you compare yourself to OpenAI, like they private company comps that OpenAI has received? Would you compare yourself to them, or is that not a proper comp?
I think in this, because I focus again on smaller and micro cap, you're looking at size and relativity of the company compared to that which you're looking. And of course, we would prefer public market comps if we're looking at the public component. But really, often as a small stage company, there are a shortage of comps that are available in the sectors that I'm working with that are relevant. So it's significant to be able to do your market homework and that positioning and be able to defend. And then that comes to the first part about the management and how can they impact their positioning. And I think it starts with the storytelling. It starts with the financial metrics. Can you lay out a very clear understanding and set of assumptions as to how your company has arrived to where they are now and where they're going in the future, which will impact the direction, the storytelling, and the receptivity of the investors.
So going back to the numbers and that you spoke about, right? So it's what, 50 to 100 million for sort of a micro cap public company. Like that's the valuation market cap size that they're considering if you're considering going public at that size.
So 50 to 300 would be micro. 300 to $1 billion would be small cap. That's a wide range, right? There's a lot of companies that fit into that small cap size. And that's kind of the initial stage of their going public through an IPO. So, that's where the decision starts to be made. And I think one of the things I can share with your audience that is one of the myths of Wall Street is that you need to be a unicorn in order to go public. It's just not true.
And so it's not true, but it does seem like so many companies don't go public today, right? Maybe using OpenAI as an example, they're getting valuations, 50 to 100 million right now, and they've stayed private this whole time. Why do companies like them with fantastic leadership, smart people advising them, I'm sure, why are they making a decision to stay private versus companies who might say, hey, I want to go public? Like what are the decision points that founders and entrepreneurs should be considering between those two? Because it seems like the trend is all private market focused.
It is. I would say, that's really largely comes down to the commitment of the entrepreneur. There are certain reasons why you might want to go public. Obviously, one of those is access to capital. So if you have private funding sources and you're happy with the structure and the access to capital there to grow your business and you want to stay private, then it's a natural. Work within the VC community, work within the PE community, work within those funding circles and sources that you have access to. A lot of the companies that end up going public are seeking a broader shareholder base. and want to go public for additional reasons, not just to source capital. So they want to utilize their stock as currency to attract employees, for employee retention, for motivating them through stock option plans, which of course you can still do when you're private, but you don't have the liquidity component to it. So the liquidity becomes a big aspect of utilizing stock as a second form of currency. So that could be for, M&A, in addition to, your employee, motivation, retention, and compensation. Could be to attract strategic partnerships. Often it's largely also just for the benefits of the transparency and the credibility that come with being a reporting publicly traded company.
Aren't there a lot of costs that go into that though too, right? I mean, like if it's my kind of financial costs, management costs or operational costs are relatively low as a private company. And suddenly if you're reporting to the market on a quarterly basis, from what I understand, and I'm a neophyte when it comes to stuff, I've never taken a company public. There are a lot more costs that go into making sure your finances are up to par, you're disclosing things properly. Those are real big questions those add significant costs, right? So is that one of the key trade-offs, or are there other?
It's a significant trade-off. I think it goes hand in hand, Adam, with kind of living in transparency of a public company fishbowl, if you will, right? So you have the additional costs. The reality to me is that if you're a well-structured reporting company, private or public, they're very similar in the form that you're reporting quarterly, with your earnings, and the projections, and all the aspects that come along with that. Typically, you're going to be audited. You're going to be reviewed on a quarterly basis. Obviously, there's a difference now of cost that comes with D&O insurance and maintaining all the compliance around the reporting. So it is not, something to step over regarding the cost. It's a cost. The way I look at it, it's a cost of operating, of being a public company, and it's included as well in the overall kind of blend of the cost of capital. So,
But I see your point. I mean, you're kind of right. Like a company that's getting to that point, that's in the 50 to a few $100 million, they're at that point already sophisticated enough. They're doing most of the things that a public company should be doing, just because their private investors would require the same metrics or same sort of quality of financial reporting. So it's not that big a difference. So then once again, you kind of answered it, but I guess I'm going to keep pushing. It's like, why aren't more companies going? Like, why isn't OpenAI going public? Like they could get a feeding frenzy in the public markets. Why are they not doing it yet? Is because they're able to raise a higher valuation still in the private markets because they can project future money in ways you're not allowed to when you're private. What is
that's a one big one. I can't speak obviously specifically to them, but generally,
just generally using them as a big,
I mean, it is also there are right now it's the worst IPO market in 30 some odd years. So not.
Which is, by the way, that's how I want to talk about that too. We'll come back to that, but I'm really curious why, because the market itself is very high now. It's like it should be good at Friday.
It's interesting because there's more capital on the sidelines, both private sector and public sector, than there has been probably in our history in the capital markets, and that's a complicated set of inputs as to why. We can certainly unpack and look into that. But the number one to me driver on why a company would not want to go public at this time is going to be based upon valuation, past rounds to what the current valuation may be, access to capital at the time of the IPO, support, and demand for another round of issuance. And there was a lot of downward pressure being put on these companies from the minute they begin trading. And so that adds a whole nother variable as CEO and as management and trying to maintain, your capital structure and the valuation that you have to deal with when you go public. So there are pitfalls, there are challenges. The large number of companies that have come IPO are not performing at or above their issue rate. So this is one of the challenges along the way. And there are trade-offs. There's no perfect answer. I've been on, like probably you, on doing it on the VC and the PE. Those come with their own challenges. I've been on the other side and done it in the public market. So, it really comes down to, choosing what the commitment is that you want to take your company. And that's one of the things that I did when I wrote the book was I want to educate people about this option. May not be the best one. And yet most CEOs of early stage entrepreneurial companies don't know that they could access the capital markets earlier should they want to.
And so what would be if I'm a company and I'm growing okay, right? Let's pretend like I'm a company that's like done pretty well, doing 150 million in revenue or something like that, in that range. Growth is kind of flatlined, right? There's I think a lot of companies like this over the past years, raise a lot of cash, good business, maybe not a great business. Should they be the ones considering? Are they the ideal one where they're like the VCs are not looking at them anymore the same way because the upside growth isn't quite there, and so they can't get the IRR they want and expect? Maybe PE would be a good buyer to them, or going public. Are those the right sort of companies that should be considering?
Absolutely. That's kind of that sweet spot where you're a little bit of a tweener, right? You're at that stage where if you had another injection of capital, then you could continue that growth trajectory and open up the additional market share that you'd like to grow. So that's where we see these companies entering. And there may even be what we see as a crossover round, Adam. So there could be one more round, but that capital that would come in wants to know that there's a liquidity event that's upcoming, right? So part of, like, we're in no hurry to take companies public. We'd say on average, you want to start 18 to 24 months before you could actually envision trading. And so during that time frame, there's typically some additional rounds of capital that could be infused. And it brings an additional set of investors and opportunities for investors to enter into the next round, knowing that there's a pending liquidity event.
So that's a fair point. I see your point. You're saying like, if you tell people, hey, look, our plan is to go public in 24 months, they're happy to come in at maybe a lower valuation today, but knowing that there's going to be a liquidity event in the relatively short-term future. They do a discounted cash flow analysis or something like that on the metrics and say, okay, like we'll come in and put money in right today, get you that next stage, and then you go public and hopefully everyone gets paid back, at least some decent amount.
Correct. And that interim round, Adam, is typically to really help the company to mature, right? To further grow and develop and be a stronger entry into the capital markets when they do their IPO.
What does a strong entrant look like? Like, what does that actually mean to be a strong entrant into the capital markets publicly? Like, so what would be that 24-month period? What would you be telling companies?
It's very dynamic, right? So that's one of the things I love about, what I do when I get to work with these CEOs. There's no one single thing. Obviously fundamentals in this market are key, right? You want to be able to show your traditional KPIs. You want to show the growth in revenue. You want to show the growth in margin. You want to show the growth in your ability to turn into a profitable, if you're not already a profitably, driven cash flow company. So those kind of fundamentals in the market like this are more and more important. I think, in 21, when we were at the peak of the IPO market, valuations were lofty, fundamentals were getting kind of overlooked. And now those investors are paying the price for those kind of early market entries, right? So I think knowing that and then looking at all the other aspects of what it is to run a public company, and I separate it in two. You've got your operating entity, and any of the CEOs that are talking about this, they already are masters of operating and building their business inside of their own sector or their own domain. Then there's a business of being public. And so we take them through a very methodical framework of looking at each aspect of their business, regulatory compliance, the SEC filings, financial reporting, basically A to Z, your modeling, and looking at it from a capital market perspective and making sure that the management understands and is aware of what the deficiencies are. It's kind of, if you think about it, we almost work backwards. We know what the market is looking for. We know what the listing requirements are, and those are both, objective and subjective, but we work backwards from the listing requirements to make sure that the company can understand and start to fill in organizationally, financially, performance, metrics, structures, reporting, so on and so on.
And is the goal still then, I maybe repeated it sort of a little bit, but hey, like if I'm going to take my company public, the reasons are because traditional private investors, especially like VCs, don't make sense for my company anymore. Maybe PE still might be an option, something like that, if those buyers exist, but that's still a relatively small pool. And then if I go public, the view is basically I'm selling myself to the public. So there are individuals who get excited by that story of my company for various reasons. And is that kind of that's the big reason, is like when you expanded the pool of buyers of liquidity who are part of that journey.
Absolutely. Access to capital, right? Broader base, institutional, different types of investors who often have mandates that they can only invest into, liquid and publicly traded companies. So you have this very deep bench, both on the debt, and the equity. And then of course there's structured finance tools, in the middle of that you wouldn't have access to per se as a privately held company. And then on the other side is liquidity. And then what's interesting, Adam, there's two types of I would say buyers now in the market: the traditional institutional, which also would probably now encompass machine and algorithmic trading. But what's more interesting are the high net worth and the retail investors that have come into the market. So probably a lot of your listeners in the community that I work within are now able to participate in investing in these public companies. The market is made up somewhere of around 25 to 30% of trading coming from individual traders.
And although the high net worth folks, they also have access usually to private market deals too. So they can kind of choose, like, do I think I'm going to get a better return? Like, I don't, you probably know like what the returns are. If I'm investing in a micro cap fund or something, ETF or something like that, versus a privately traded, either micro cap fund, VC fund, are the return profiles similar, or is the question more about risk reward profiles and just being diversified?
I think it's more the latter. I mean, everybody has their different targets for their ROI, but the liquidity component is a big thing because people, even a lot of the traders that I know and that I work with, they're short term in their thinking. They have the ability to exercise and to get in and get out, even throughout day trades or spot trading. So it's a different form of motivation. I think ultimately for the company that's going public, they want to build a broad shareholder base and have access to that. So we're very focused on building the capital structure. And I think this is a message to any of the founders that are looking at this: is start to organize and architect your cap structure towards a public event and or a liquidity event. And obviously, we want the broader the base of shareholders, the better. From our perspective, like to give an example, you need 300 to 400 shareholders just to enter into, being a publicly traded company. And be amazed how many companies come to market without that. Then we have to go and get a retail, investor.
Really? What do you mean? Like you mean they don't have just investors, or they don't have that many like people on their cap table?
Right. Round mod shareholders, which, in this case is a very small number. It could be 100 shareholders. But if the cap structure isn't organized around a certain number of shares, issued and outstanding, and then you have to restructure, a lot of those potential investors get changed in the way, or they're debt holders or convertible note holders. So we look at all of this from like a 360-degree perspective, and there are cures for it. But if I'm starting now and I'm a CEO and I'm looking towards capital markets as an exit, I'd want to really spend a lot of time organizing my cap structure now, so you don't have to change it or redo it as you get closer to a liquidity event. And a simple way to really look at that is just having a well-organized and diverse and broad shareholder base that, would fit inside of a number of shares issued and outstanding that would be ideal for, a publicly listed company.
Okay. What are the biggest downsides of taking a company public? So, I mean, you mentioned one, at least in my opinion, which would be the short-termism of the market. Like I'm my own company. I'm very focused on the long term. I think us making investments today will have massive payoff for us in the future. But of course, every investment, it takes a little time to pay off. Right. And so were we public today, the market might hurt us because we're cutting our cash, sort of our profits and our margins, because we're reinvesting that into the future. The same way, frankly, Amazon did for a long time, but Amazon had great growth. And so they went public pretty early, things like that. But I mean, what are the major downsides that were I an entrepreneur, I should be considering about going public versus staying private or other access to capital options?
I think first and foremost, Adam, is control, right? If you're currently founder, CEO, or part of a C-suite, or a group of shareholders that maintain control over your company, you can dictate the direction you want to go in within reason, right? Within, being fiduciary to the stakeholders. Obviously that changes when you're public. And now you have, for the first time, not just the stakeholders and shareholders, you have a board of directors to be accountable to. So for a lot of founders and very kind of traditional entrepreneurial mindset CEOs, that's a big change, right? It's to me, one of the bigger challenges of migrating from, a private CEO into a public. And I think many companies underestimate the pressure that they're going to be under from the minute that they get public, right? So that's, another one. It's really, you have to be very thick in your kind of skin as CEO to understand and that you're going to be taking scrutiny from pretty much every direction and taking input from people that have a role inside of your being a public reporting, and trading company.
And so, kind of a good segue into a lot of the other meatier parts of what I like to talk about. What does success really look like for these founders? What is an excellent entrepreneur? Is it an entrepreneur who can say, you know what, I am thick-skinned because I got to this point, right? To get to a point where you have a company that's doing 50 to 200 million in revenue, you're pretty thick-skinned already. You've gone through a lot of ups and a lot of downs. But should then your focus be, you know what, I can handle a little bit more scrutiny because my goal is to make a lot of money for my shareholders, and that's like the actual end goal? Or is it? So what are the key elements of the best companies you've taken public and the entrepreneurs who lead them? What are some of the things that you think they all share? Or about on the flip side, of course, ones who failed on that front and who haven't done it, what are elements that they share?
I think the number one thing that comes to mind, Adam, is a commitment. If you're going to go down the pathway of going public and enter into being a publicly listed company, you need to be 100% committed going in, and then for a period of time of leading that, through a stage of growth and fighting through the challenges that come, along with that. Many of the CEOs that I work with, they have it as I'm going to say almost like a bucket list item. Like they have the dream of ringing, the opening bell, a closing bell at NASDAQ and NYSE. I've done that countless times, and it is exhilarating. It is an incredible journey. By itself, I wouldn't recommend that would be the motivator for going.
Yeah, I would hope not. I hope you're doing it because it makes sense for all shareholders as well. It's maybe it's a nice additional benefit, but not the right reason.
Of course, but it is a driver for, let's be honest, a lot of entrepreneurs, including myself, when I was younger, had that ego-driven goal of wanting to go do X, whatever that is, right? And
sure. I certainly have that as an entrepreneur too. Like you feel like you made it if you managed to take your company public. It feels like a checklist bucket item. You've succeeded. Although, of course, once again, it's changed over the years, but I still would view that as a success.
No doubt. And I think that if you are a typical entrepreneur where you want to align your strategy with the IPO ambitions and access to capital and to really grow, there's no better place to do that than, a NASDAQ or a New York Stock Exchange listed company. It's kind of like, to me, the ultimate level of being on the playing field. And you have to be ready, of course, for the fluidity of what's going to come as a CEO and a leader. And one of the obvious lessons is be prepared with your contingency plans, because just going public isn't enough, right? So many guys get focused on, let me just get there, that they don't realize that that's when the hard work becomes of now growing and building a sustainable public company.
Well, and so many of those companies have failed, right? There's so many stories, and I have a few in my stock portfolio where luckily I would say I sold a bunch of them before they really became dogs. But like there's a bunch that you go from public and they're 97% down. They completely, they went public in a really kind of crazy bubble market. This is during COVID in many cases, but even then, the fact they've lost 97% of their value is shocking.
It is.
What did those companies do wrong? Where did those founders mess up? Or maybe the founders didn't. The founders said, you know what, going public, get a massive valuation. They sold all their stock when they had lockup period was over, and they're out. They're like, peace, done. I unloaded my stock to some sucker, and too bad. Like, what are the trade-offs there? How does
realistically, and that's one of the other misbeliefs, I think, is that entrepreneurs think that if they go public, they're going to be unloading a block of their stock and they're going to be on easy street. It's just not the way. Insiders are locked up. They could be locked up for a year. They could be longer. There could be leak outs. There's all kinds of disclosure around selling. So I think, there was an overemphasis on some of the short term and beliefs that entrepreneurs are going to be able to kind of get there and, ride that coattail. This is a long-term strategy. You need your midterm and your short term typically is driven by, being able to have access to that capital. I think why so many of them have struggled is that they didn't meet the fundamental promises, commitments, and performance that was expected from the markets and or provided as guidance from the companies without being able to support hitting those metrics on a consistent basis.
So is the essential trade-off then, if you go public, the public markets give you cash and capital. In the theory then would be that new capital you're going to use to build the future, right? That's sort of the investment capital you have to build the future that you once again couldn't get from other places. That's the trade. I mean, assuming that's like the fundamental trade-off of why
Yes.
you go public. And then when they do that, so walk me through some of these companies, maybe ones you either work with or just about their stories. Where did they fail, right? These are companies who built great, like I'm thinking of like two that actually I was an investor in. But full disclosure, I have like I know 5 shares, some tiny amount just to track it still in them. But like Smile Direct Club is one, and like I think Beyond Meat as well, both of which have gone like 90 to like 98% down. These are smart founders. They built great companies that were doing wonderfully. And then suddenly it all changed. Like what went wrong? Where did the founder mess up? Or what goes wrong in these companies where they're big hopes and dreams when they ring the bell at the stock exchange 12 to 36 months later are in the dumps? I mean, it's a failure.
Yeah, unfortunately, a lot of those dynamics are outside of the control of management. And in today's market, also, you have all this downward pressure that's coming from, market sellers, even shorters, both, legitimate and naked shorting. So if you put that part aside, but it's a significant factor. I don't want to step over that because those are out of the control of management, right? They don't have the ability to impact and implement their business plan, while combating all those other components that are out of their control.
So does that argue then about not going public? Ideally, like those companies went public and these things were out of their control, but then why would anyone take that risk? Until you're like a guaranteed perfect success story, why would you even take the risk? Just stay private. They could have kept raising tons of money, not had to deal with all the public pressure, and then maybe gone public a few years later, but at a healthier valuation, or at least one that would have stood up.
The why I think will continue to come back at them to access to capital, and or that there's a shareholder base and the investors that are also driving a liquidity event, which is often the case, right?
Yeah.
Right.
Okay.
So there's a lot of different reasons why I think I would say yes, you have to be very careful in this environment to want to choose to expose yourself at an early stage if you are still developing the foundational aspects of the fundamentals of your business.
Okay. So going back then to the best of the entrepreneurs, right? So you've worked with, I'm sure, dozens, if not hundreds of founders at this point. You build a bunch of your own companies. What is success? What does entrepreneurial excellence mean to them? And what are the key skills and abilities you think that the most excellent of them have?
It's interesting, Adam. I think success means different things at different stages of your career, right?
Walk me through that too, even for you. What's changed?
I can start with myself. Like, at 60, right? I started my first company in my 20s. There's just such a migration of growth more towards, I would say, the value and the reward that is intrinsic, but not necessarily just financial, right? So as a younger CEO, younger entrepreneur, it's on hitting the revenue, hitting the growth, right? Hitting the earnings, all the traditional kind of KPIs that we would look at. And then there's value to your shareholders, value to your customers. I'm a very value-driven guy. So that's where I always would start to look for all parties. And that continues to be the focus on the value part, but I'm less focused about hitting, revenue and profitability numbers that I am about being able at 60, to fulfill upon my vision, to fulfill upon a purpose, and to be rewarding others from non-monetary aspects that are, I think, more about quality of life than they are. So that sounds a little altruistic, perhaps. But for me, success can take a range, like giving back and mentoring, as an example. That's a sign of success for me that I can do now. That when I was younger, it wasn't a focus for me. I was more interested in going out and performing and making money and ringing the bell.
Yep, I can understand that. Do you think then that is still, what are the driving factors once again for these the successful entrepreneurs, the ones who think are achieving that success, and once again, are the best ones driven by a financial gain because they're probably maybe younger in their career, not always, I'm guessing, but like younger in their career, and it's a financial outcome? Is it, and is maybe that a requirement if you're trying to go public, as an example, like, or get an exit, is you're kind of driven to maximize shareholder gains? What are those elements when you're like, these are the sort of ones that I want to go work with? The ones, if you're like, if I could choose my ideal clients, What are
Well,
the,
the first thing that comes to mind is passion, right? You want to work with guys that are just passionate about what they're doing and they have a vision for which they are driven and have that intrinsic just drive and desire to go out and perform.
is that not everybody you talk? I agree with that, but I almost would assume that's like a default requirement to get to a point where they're even having a conversation with you. But maybe you're implying it's not actually always the
It's
case.
not. I think there are well degrees of passion, we could say, Adam. Right? There are
Sure.
nuances, but it really is aligning that passion. Then so you would put the ability to know that you're backing a team that has the skills, right, the vision and the values aligned, and being able to support the passion. So it can't just be passion by itself, right? So if you're building the right team, that kind of dream team, then they have a performance track record, knowing that what they're taking on is going to be the next level of growth, right? And the
Yep.
common challenges that come along with that. But if the passion is there, the purpose is there, and there's an eye on profitability, then those are like the three P's that I like to look at when I'm starting about the selection process.
Passion, purpose, profitability. And how many of them compared to the ones that have failed? Like, is there a difference between those? Like, have you made mistakes in sort of judging those and be like, oh, I made a mistake. Like you sold me on a bill of goods that wasn't
Yeah, I
accurate.
think the mistakes that I've made, even with some recent projects, were buying into the story, buying into the team that hadn't yet proven that it has the grit and the sustainability to be a publicly listed company, meaning just too early in the life cycle. And then where I see the two big killers: ego and greed.
All right. So okay, explain those to me because I can imagine also to be a founder who's getting to that point in your career, there probably is a level of ego and maybe greed. You have to have a level, I think for every entrepreneur, you have to have a level of hubris
Mhm.
to some extent to be willing to believe you can create something brand new the world hasn't seen before and then convince customers to buy it, which implies you built a product that the world does want. That takes a level of hubris no matter what and
Agreed.
ego.
And,
So like
and and there's a
what
positive
what is the
there's a
fine line?
positive side to that, right? And I'm like, that's what I think you're pointing to. And we want that, but we want it in a humble, realistic, kind of in check, right? Ego in check, where it doesn't become, overpowering to making decisions that may not be aligned with kind of that, you know, pathway, as opposed to just someone's opinion about it. So, when you're now in a role as a CEO of a public company, you've got your C-suite, you've got your board, that ego and that insistence upon doing things a certain way that might have worked in the past, that may not work or serve you now and or going forward, can be detrimental.
So do you then suggest a lot of these founders get coaching? Like what how do you solve for this? Because the only other option then is like you throw the CEO out, which I'm sure happens plenty of times, but that probably has its own.
Yeah, I like to look at it as practice, practice, practice. It goes back to the beginning, and we're talking about a commitment. If the CEO is committed to, being a public company, and you're starting, I would run your company like it was public for a couple of years prior, so you get used to understanding and working within a new structure that's very different from the hubris and the ego that is driving you to success when you're building your company as an earlier stage private entity.
What are the sort of to go back to that point a little bit? What are the key elements where you're like, okay, run your company like a public company? What do those things look like? And when does a startup think about that? Is it when they hit a certain revenue target? When you're sort of saying like, hey, like, does it matter if you're $1 million ARR company, or should you start doing it almost right away just for a level of discipline that it forces you?
I'm a believer in the earlier the better, right? And you have to be realistic. You're not going to hire a GAP PCAOB auditor, if you're at the early stage of your growth. But you can take on the approach that I'm going to have, quarterly earnings. I'm going to run through all my KPIs. I'm going to be able to project and be held accountable to my performance. I'm going to have the controls and systems in place from a financial reporting perspective to support that. I'm going to have a staff that's trained and educated and knowledgeable about what it is to be reporting as a company on a quarterly basis and an annual. So you can start to get that run there. You can do the same thing with governance, right? I can go all the way through, but I think you get it. Each area So the sooner you're operating, and that doesn't mean you have to go public, Adam. I think the misnomer here is that you would only want to do these things if you're headed towards, an IPO. Well, those same best practices could be applied towards M&A, trade sale, and or just good structured growth. The tighter you run your container, right? The tighter you run your ship, the more valuable you're going to be to all the stakeholders.
And do you think founders don't do that sometimes because it's too distracting? They don't want the challenge. They don't want someone looking over their shoulder. Like, what are the reasons why founders say no to that? Because it seems like a smart.
Well, I think it's a combination of all those things. They're focused on revenue, right? They're focused on hiring. They're focused on tech. They're focused on, X, Y, or Z. And then that becomes, the driver, right? That's where really, if you look at the heart of an entrepreneur's business, it's about fulfilling upon that vision, right? And then typically that's all operationally organized. The smart ones that I know with align in parallel the financial controls and systems, but it's almost always for a revenue driven kind of founder, it's the afterthought. And then controls and, accountability and governance. Well, who wants to deal with that if you don't have to, right? So, it's a discipline, Adam, right? And what I've learned at 60, I didn't do when I was 24. I didn't do it in my 30s. I started with it in my 40s because I entered into the capital markets then, and I saw the structures, the benefits and the rewards of operating that way, even inside of companies that never even made it through their IPO.
And if you were to give advice to your younger self about some of the things that you would recommend doing, and pretend that same as our audience to some extent, what would you say? Would you say like, hey, put these capital controls in place, don't skimp on that, put in some real sort of investment? Or is it like, hey, look, you got to get none of the capital controls to some extent matter if you don't have growth and you don't have revenue and you're not able to go get your next fundraise? Because if you go out of business, even if you have the cleanest books in the world, but you're not out of cash, it doesn't matter.
Right. Yeah.
But what is that advice?
I'm more on the revenue, mindset, right? Like you really need to have a business that has traction. You need to have a demand for your market, your service, your technology. And when that's in place, then you can value engineer what to do with all the amount of capital you have below your gross profit. And I would then begin to allocate percentages and budgets towards developing these controls and systems and structures. So you building and growing and building that infrastructure at the same time, but you're doing it in a very controlled manner.
Is there a percentage of like revenue that you see the best companies sort of spend on just sort of capital controls, operations, things like that? And by the way, I'll say like, I look at this from my own company's perspective because we do back office operations. A lot of public companies are spending 5 to 10% or almost 10% on like just running the back office. Now, we're talking very specifically in this case on the financial controls part, so it's different, but companies do allocate a lot of cash to it. What do you see or recommend people sort of just budget in? Be like, hey, like you just spend 1 to 5% on just like good capital controls and like a good bookkeeper and accountant in audits?
Yeah, I think they pay for themselves. So I think the percentage is depending on the size and the scope of the company. 5 to 10 could be in that range, but good financial controls can pay for themselves in the cost of the infrastructure. So there's two sides to it. One is just the quality of the reporting, and then being able to have an efficient reporting system and utilizing that information as knowledge and how you make your decisions as management. I think it's critical, right? And most entrepreneurs, myself included, when I was young, I would get my information later than I wanted it and or in arrears. And by that time, the race is run. It's harder to move and to shift and adapt. I'm a big believer in adaptive management. But I think more importantly is when you're looking at financing and rounds of capital, investors are going to want to have insight into the quality of your books and reporting, right? The financial projections, the financial modeling, all of those are kind of critical components of a well-organized and structured, financial management system.
How much of this do you bring in-house versus out of house? Do you need to have a CFO? What are the right people you need for the financial elements if you're kind of headed in the I'm going to go public direction? And when does that happen when you bring people in-house versus like, hey, we can just outsource bookkeepers?
I think you can keep most of it in-house, with the exception of being able to find, an outside accounting and or auditing and tax firm. Eventually, you'll get to the size and scope where you want a full-time in-house CFO. There are plenty of outsourced kind of fractional CFO services that I think are very helpful as you're in that growth stage to be able to give you the understanding of what's going to be coming. And then there are certain pitfalls in your financial cap structure that you definitely want to make sure you get outsourced, legal and financial input that can be impactful, derivative accounting, warrants, safe notes, convertibles. All those components require, I think, to have at least, if not in-house CFO, an outsourced CFO. At the time, let's say now you're in the 2-year scope where you've said, okay, I'm committed, we want to go down this path. Typically, then that's when I'm recommending you start looking at a full-time CFO.
What are the sort of a little bit going back to some of the IPO stuff, but what is the amount of allocation from a cost perspective people have to put aside or set aside from a just cost to go public, right? So yes, you're going to raise a lot of money, but you need to set aside money to pay for folks like you, Peter, and then also, of course, all the other people who are going to be helping along the process. How much money is set aside for that? Or is it almost like a success fee where like Peter's real money is made when he gets you to a successful IPO versus fees you might get over the first?
Well, now you're speaking my love language, because that's my business model. We actually charge a very low retainer during the period of 12, 18, 24 months, because we don't want to take critical dollars away from operating. And I make most of my money in our structured deals are including equity in the companies. So we're aligned with our clients and wanting to have a successful listing. We won't take on a client unless we know we can be successful with their listing. And because that's how, our business model is organized, so that this is not a transactionally oriented deal for us, where most people in the micro and small cap, they're transactionally based. So we're very unique. From the other value add is we bring in and reduce a lot of the costs by negotiating and structuring compensation with outside third parties within the ecosystem, accountants, auditors, securities counsel, so on and so on. But to answer your question directly, I tell companies to plan on $1 million budget. I've done it for significantly less when I took my own company. Now it was some time ago, but I'm scrappy that way. I don't like spending money on things that aren't adding direct value. And we want to take every possible dollar and put it back towards operations to be able to help leverage, growth, key hires, so on and so on. So that's a broad brushstroke. And then there's the obvious about, the cost and complexity of the company for the audit, for legal, those can be, variables depending on how well organized the company is, how complex their business is, and the structures of which, they've already imparted from financial and from a capital perspective.
How does one choose? So going back to that point, how does one, if you're thinking of going public, how do you choose the right advisors? Like, why would I choose you, Peter, Exchange Listing versus other players? Like, because everyone's going to say, we're great, we're going to get you the highest valuation, we have the best way to do it, we're low cost. Everyone probably is the same pitch. So how does someone, especially, and this is a challenge I'd imagine, because for a founder, this is probably the first and maybe only time they're ever going to go public. Right. So this is not a skill set they have in choosing the right advisors. They don't know how to go do it. So how do they go about it? What is the advice you?
It's, first of all, you want to find somebody like anything else, Adam. You want to find somebody who has relevant background, experience, and current in the marketplace. And that last one is probably the most important to me of late, because I know, Guy, did I joke about it? If you've done 2 IPOs, you're an expert. Well, we did 6 last year, and the commonality of each one is that they're unique and different. And the nuances of the market keeps changing. Regulatory, investors, investment bankers. So current market intelligence, critical. Finding somebody who is going to be the champion of your deal. It's the same thing I say about selecting an investment banker. You want an advisor and or a banker who really is going to be the champion, because this is a complex, chaotic process. And you need that champion who's going to be committed all the way through. And then ultimately, somebody that is aligned with the business model and practices that are going to be a good fit. If a large cap company comes to me, I'm not the right guy. I'm a small to mid, and the other way around. You don't want to be, choosing a wrong tier advisor that isn't the perfect fit for where you want to grow into at the time of your being public.
It's part of it too. I mean, I assume there's some like just relationship building. Like, do they like you? Do you guys get along? Because you're probably going to be working really closely together for a long time.
Started there, and I always kind of like end there. It's like life's too short to spend time around anybody you don't enjoy working with. and ultimately, as entrepreneurs, we're also very dynamic, kind of very excitable, and so there's a common cultural aspect that I think is really important in who you choose, not just as your advisor, but across the board, right? The service providers, banker, your board, A to Z, because you're ultimately have built a culture to get to where you are thus far. And that cultural aspect for me is critical. It's actually what got me into the capital markets, was working with a company who I had been a private market guy, who said, "Hey, we want to go public." And I said, "I don't have that background." They said, "No, we know you. You've been working with us for a year. We trust you, and we all like each other. Go sort it out." And that's how I entered into, kind of the microcap markets as doing my first public entity.
So walk me through that a little bit. It's a great segue into your own history a little bit. You were in, I think, food services previously, a long time ago. How do you go from food services to now being a finance guy taking small companies public? That's a very big difference.
It's been a journey, Adam, for sure. I was 24 when I started my first company. I had my first exit at 30, and
not bad. So 6 years later, and you're at 24, you still have a lot you don't even know. So how did that even get started? Were you just a crazy 24-year-old? Like, I think this company needs to exist and I'm just going to go do it. Were your parents like, "Peter, you're insane"?
I always wanted, I knew I would be an entrepreneur. I was actually working in New York in the restaurant industry. I was working at a place called the Rainbow Room, which is very, very, famous.
It was not like famous party place,
Top of
right?
Rockefeller Center, 2 floors. And, I wanted to pursue a career in hospitality and in the restaurant industry. And after a year inside of what was a very big position for me at the age of 23 and working with the chef and working in procurement, there was an opportunity for a company that had gone out of business, and there was no other supplier in the city that could help fulfill their needs. It was very kind of high-end esoteric produce. And back
They went out of business. Was it not a good business, or was it
poorly run? It was partly subsidized, and it was just a kind of a market failure, which happens. And there was what I think is a fundamental of any business startup. There was an unmet need and a strong demand in the market. And so, I took that leap then, knowing that there was this market opportunity. And my first client was inherent built into, the Rainbow Room. And then I went out from there and had every one of the better New York restaurants and wholesalers and distributors that were the companies that really were the backbone of my career aspirations, that now I turned into clients and into, some of very long-standing relationships.
What do you think gave you the confidence to go do that? I mean, did you have a little bit of family money? Did you have some protection? Like, what was making you feel like, I'm comfortable that I'm going to go take this risk and take on this company that just went bankrupt and went out of business, and I'm going to take over whatever's left of it, resuscitate it, and make it happen? Why am I 24 going to be better than anyone else? And I can take on this risk. Maybe you just didn't care because you're 24 and you're like, I can take on the risk, and what's the worst that can happen to me? I don't know. Like,
right. And it's funny because it's the latter, Adam. It's that mindset of, okay, I'm 24. I've always wanted to be in business for myself. I'm going to take my shot. Worst case, I didn't have family money. I wasn't capitalized. I didn't have a huge amount of cash behind me. It was opportunity and hard work. And that today is still the driver of the intrinsic values, right? Like that journey for me of when I try to go back now 30 some odd years as an entrepreneur was filled with curiosity and ambition and the typical, I'm willing to take the risk for the rewards. And that leap has fueled, for me, the entry into the capital markets was driven then by access to capital to grow these companies. And so that's was really the theme. It was a natural progression. I started my own investment bank. I built it from scratch. I've done a lot of unique things in the industry. The commonality was always that there was a clear demand that wasn't being filled. It's the same way when I started Exchange Listing.
And I assume that's the case for like almost every industry, right? Every entrepreneur, they're theoretically fulfilling it, finding an unmet need and fulfilling it. Are there any unique elements of the businesses you've started or the ones you've taken public that you think make them slightly better, right? Because there's hundreds of thousands of entrepreneurs every year that think they are solving a need in the market that exists, and it turns out they're wrong. So what made you right, it sounds like, more often than not? And also the companies, once again, you've taken public. Like, what is it differentiating?
Look, I've had plenty of failure along the way, Adam, right? And I actually went through extreme hardship during the Great Recession. not necessarily by my own bad entrepreneurial choices, but by being a victim of the market and macroeconomic and microeconomic
Tough
changes,
for
right?
everybody.
I think what I've seen over time is like what you said. Not I think there's a market for this, not I believe, or there may be. You need proof, right? You need empirical proof that there is a big enough market to support your entree, whatever that may be, and then to be able to innovate and adapt because it's not static, right? It's the one thing that I would say has gotten me through every one of my challenges as an entrepreneur is adaptive thinking and adaptive management.
In sorry, define that maybe. Adaptive management, adaptive thinking. How do you define that, and what does that actually look
So
like?
for me, part of the way I define it is knowing that, business is dynamic and it's not static. So there's going to be planned challenges. You want to go into a new market, you want to expand, you want to bring on, whatever that may be. And then there's unplanned. And those unplanned, coming out of COVID, we could talk about geopolitical. There's all types of examples right now, maybe more in our career as entrepreneurs. And so the ability to adapt is to really embrace that uncertainty and look at then the birth of innovation and expansion and change that comes as a necessity to meet the demands of what's going on in the marketplace. It's adaptive to be able to step back and say, okay, how is my business impacted? What are the components of the changes in the market? And then how do I need to shift as a leader to be able to fulfill upon those, to be nimble, to be lean and satisfy the demands of the market?
Have you done that with, and have you found that the most successful entrepreneurs or excellent entrepreneurs have done that with partners or a team, or has it more been like you just like you have a new idea, get started, you figure it out? What has been the secret sauce when it comes to you mentioned culture a little bit earlier, having a culture and having a team behind you to go do that, because it can't be all by
No,
yourself.
it can't. And that's one of those when we were talking about ego that, you really need a team of people that are aligned. And that's in the vision, right? And in the culture, and then making sure that you've worked through kind of the roles and accountability. I think obviously, I'm a big believer in visionaries who are going to lead the way. Then you have to have a group of well organized, aligned people to help execute and implement. So, it's essential to have that kind of quality in the founder and or the founding team, right? Because a founder could be, two, could be three guys that are aligned that each have then the ability to impact where it is that you want to go towards building and fulfilling upon the vision.
So have you usually had co-founders for your
I've done
businesses,
both,
or
right? I've had founders, co-founders, partners. I think I've been on every side of that trade. And there's no doubt for me that the best is where I know that I'm in a role that is designed for me to do what I do best and to have partners and support in the areas that I'm weaker in or that are not my natural given strength. Like I'm a big picture guy. I'm a visionary. I'm less interested in the details. I'm less interested in, certain, components of managing the necessities. So I have picked really great partners and people around me and or key hires to support my strengths. And I think most entrepreneurs think they can do and do end up much more than they should that are outside of their real value proposition.
are there secrets you've learned over the years of how to recruit, hire, train, and just find those really good partners for you to surround yourself by? Because it's one thing to recognize you maybe need that help. It's a whole other thing to recruit those people to join you on this sort of crazy journey where you're like, I'm starting a new business. It doesn't exist. It needs to exist in the market. How do you identify and find those people and convince them to come join you? And what have you learned over the years to make you presumably better at that than you were?
Yeah, we just went through this where we had someone who was the ideal candidate on paper, all the criteria that you would ever want in a candidate. And when the day is done, we chose to go in a different direction because we want that passion and that kind of moxie of, hey, I'm excited about this as an individual joining a team. Not just that you have the skills, but that you see the vision, you align with that vision, and you're willing to put yourself into the team to play that role, to play all out. It's kind of like, fierce competition. We want that kind of hunger and that, buy-in as to what we're doing, because that attitude and that mindset can overcome a lot of weaknesses that may occur when you're faced with the growth of building a business.
So then once again, are there things that you try to look for, recruit for, how do you find individual in what's that
Relationship,
space?
relationship, relationship. Right? I feel fortunate, Adam, at this stage. I've got a very strong network. We've got great relationships. Like I'm going to be hiring, so I've got a role I'm going to be filling here soon. We're just going to raise that within our community and start
Mhm.
there because that's where there's existing relationships and some sense of people knowing who we are and vice versa.
Yeah, no, that's smart and makes sense. Are there other once again, is that the same advice you'd give or things you've seen from the best entrepreneurs you've worked with? Is it relationships? Is it their ability to recruit? Is it storytelling? Is it the moxie and ego that they have, but a little bit of EQ as well on top of that? What are the elements that enable them to build great teams? Because once again, if you're at the 50 to 300 million in revenue, you have some level of you've done something to build a team to help you get there.
Yep, no doubt. Skills, right? Vision, value alignment, right? And you mentioned, EQ and storytelling. Those are, I often start there. I think that they're critical to be able to tell the story that's enrolling and engaging and authentic. And that's where the EQ
Mhm.
often kicks in to me is, people want to be around real, authentic, heartfelt, to know that they're part of something that they're cared for and that they're important.
Yeah. Do you think that's actually changed at all in any way with like different generations? I mean, we all like to say, "Oh, the younger generation has these issues," and it's funny. I find myself saying that sometimes nowadays. But like, do you think that changes with generations, or it's always sort of the same thing? It's like people want a level of connection.
I think they may not know, like we make people, especially if I'm talking about the younger generation, don't always know that it's important and what they per se, how critical that is. I think it comes down to one thing, which is the integrity of the relationship. And if that integrity is never compromised, then the rest will take care of itself.
Yeah, no, it's fair. Are there other key elements you think about when to just be really general about excellent entrepreneurs? Are there other key elements you find that the really good ones have, the ones who can take a company public multiple times or build multiple successful companies? I mean, once again, you've done this yourself. Are there things that set you apart compared to others? Like don't be shy and bashful.
Yeah, I think it goes hand in hand with everything we've spoken about. Bring both the investors with you that are aligned, that are buying into your vision, and they are supporting your vision, makes for a really, really strong leader. And
Mhm.
that's side by side with, of course, the team. And the CEOs that I've seen do really, really well seem to have mastered the ability to have both of those happening simultaneously where they've got the investor support, they've been able to have, they have a following, they've got a track record, they can tap into that depth of stakeholder on both the investor side at the same time while building a team that's loyal and that they can tap into as needed to bring those resources to go to a higher level when being called.
Yeah, it's so it's basically a really someone who's a really good juggler is maybe one way of putting it. You can juggle a lot of different balls and do it
Yes.
well with a level of integrity. So Peter, when you think through one of the questions I ask everybody on the podcast is if there's one piece of advice that you would give to every entrepreneur to think about as they're either building their company or maybe more so in your case, thinking about going public, what is that piece of advice? I mean, boil it down to one thing, which is always difficult. What is that one thing? Like if you get really good at X, do X, or make sure you have Y skill set. What is that one thing?
The first thing that comes to my mind, Adam, is staying steadfast in your vision
Mm.
and in your commitment.
Is it so? I actually love that. So you're essentially saying the idea of kind of having grit and focus and not deviating. And are you saying that actually? I want to dig in that for a second. Like, are you saying that basically because you've seen too many founders who do deviate? They get one bump in the road and like, oh, we need to go in a different direction now, and it just throws everything off. Is that the implication of what you're saying?
It is, and it's also like diluting yourself by having too many doors open or too much optionality. Example, I was on with a EV company today, and they had three different business models, and I the just to say you need to be able to tell me what business you're in, not three different lines of business, all at the same time. So I'm a big believer, we talked earlier, you have to adapt. But if you're
Yeah.
steadfast in your vision, your commitment, and then you understand you're going to adapt as needed to satisfy market conditions or changes that occur. But if you're waffling from the beginning, investors, employees, the market, they see it, right? So I think being steadfast really means understanding and staying true to your vision, your commitment, while being able to adapt to the current marketplace.
It's a great point. I mean, if you think about it's something I haven't heard other people say, but it's a really, really good point. I mean, if you think about some of the best entrepreneurs out there, best being sort of most successful from a financial perspective at minimum, Elon Musk or Jeff Bezos, things like that. Like Jeff always had a very clear vision of exactly what he wanted Amazon to be, and he didn't deviate from that basically forever, arguably still today, even though he's not CEO. Elon Musk, same thing. Like the whole world can essentially identify, why does Tesla exist and why does SpaceX exist? SpaceX exists to go to Mars. That is a vision they've had almost from day one, and that is a crazy vision. But they've stayed true to it the whole way through, and it's just building and compounding all the tech, the work on top of it. And someday, I bet most people would say, SpaceX is going to make it to Mars, which is crazy. But it's credit to him for having a very clear, simplistic vision that everyone can get behind, even if it sounds completely insane, and just not deviating despite all the hardships all those companies have faced.
It's great. It's a great example, and it's really great lessons for life.
Yeah, that's also true. Too many people jump too quickly around and never build any real core competency in anything, which is a shame. And then you look back on life and you're going to regret that.
And that's part of what, in those kind of, the parting wisdom for entrepreneurs, right? It's like hardship. I've gone through some very significant hardship as an entrepreneur. It shaped me into being a much better businessman, into honestly being a much better person. But to stay on the entrepreneurial path, those lessons learned have honed my skills. And so, while you can stay steadfast to your vision, while you understand you have to adapt, you're going to fail. But learn from that and let that hardship be the driver then to take you to the next level as an entrepreneur.
Yeah. I know on the topic of but I think too many people, frankly, in the world are scared of failure in general. Now, entrepreneurs, not so much so. That's the whole kind of the risk you take to being an entrepreneur. But lots and lots of people are really scared of failure and therefore never push themselves and never test themselves, which I think it's a shame. But nevertheless, with all that said, Peter, how can folks get in touch? How can they find you if they want to ask you more, learn more, read your book? You can find it certainly on Amazon. But how can people find you and get in touch if they want to either take their company public, learn more just about being a great, successful entrepreneur?
Thanks, Adam. The easiest way is LinkedIn. I'm very active. I put out a lot of content around the topics we've talked about the IPO markets, around small cap, micro cap, about governance, about leadership, about management. So you feel free to follow me there, connect with me. If you're interested in the book, I'm more than happy to provide one to your listeners. Just direct message me on LinkedIn and we can connect and we can share information.
Amazing. That's great. And actually sort of a bonus round question for you really quick, which is we never focus on it, but I'm just curious for my own edification. Why is the IPO market not good right now? Given the market itself is almost at all-time highs, why is the IPO market still seemingly somewhat closed for IPOs?
Wow, we need more time, Adam, but right.
Fair enough. We got 7 minutes in the calendar still. So, but yeah, what's the high level for the bonus question?
I think it's really simple from the financial investor side, that the investors in IPOs haven't gotten the returns that they need for their portfolios, and that it's been more valuable for them to buy on the open market and get returns than take a risk of being in an IPO that will then price or fall below its issue price. And so it's a very pragmatic answer, but I would say the same thing exists right now, not just in the IPO market. If you look at VC and private equity, there's trillions of dollars on the sidelines, sitting on the sidelines. Now, is that geopolitical? Is it economic? Is it due to the interest rates? Is it, post? We could go through, is it, any one and or a combination of all those things? Specifically in the IPO market, I would say it's a factor of all the above. But the biggest driver against someone taking a risk is the concern about performance in the current market and providing them with a return on their investment.
But is that then a function of it, almost like a hangover from the SPAC craze or something, where because obviously the companies that are currently in the public markets and doing well went public at some point in time. So is it then a function of the companies that are being brought to market are lower quality in the past 5 years or something? Like what is it that makes companies going IPO today different than ones in the past? Like, I guess that's where I'm confused about why people are scared of IPOs. And I get they've been burned.
Well, there's also this disconnect, Adam, between prior valuations, prior rounds, and
Sure.
current. And there's an arbitrage right there. Unfortunately, it's mostly in the negative in the way of down rounds coming, and or companies and investors don't want to risk the negative component of the valuation once they're in the market. So there's no one any particular reason why. I think there's a lot of complexity around this topic and a lot of indicators that all boil down to the same thing. It's risk and return on investment. And because of the inflated valuations, because of the challenges with money being on the sidelines and not entering and supporting these new issues, you have companies and capital waiting. And in my belief, once the window opens up, you're going to have another significant market set of entries. The pipeline is there. There is this huge demand. The money needs to be deployed. It doesn't make money sitting in the coffers of, right? So,
Like 5% maybe if you're lucky or
right,
something.
exactly. Like, in our fund right now, we're giving investors a 12% return because I know I'm getting 30 and 40% returns, when the investment vehicles that we're doing. And we've
Wow.
restructured that to reach high net worth investors for these reasons. I have a high yield instrument that whether the stock goes up or stock goes down, I invest in an IPO, I make money. So, we have a unique kind of insight into all of that. I would not be necessarily as bullish if I didn't have that yield and the protection of investing into the IPO market currently, because the metrics are just not there to support getting the return that we would want for our investors.
Yeah, that's so a lot for investors to think about. Certainly a lot for me to think about if I'm lucky enough to get my company to a point where we're even considering an IPO. I know who I'm going to call first. So Peter, thank you so much for being on today. I appreciate it. Thank you for the time. Yeah,
Thanks for
appreciate
having
it.
me, Adam. It's great and look forward to more.